My formal name.
Maybe week 33, I'll be 100% ready to go on this. Maybe I'll figure it out. We're live, man.
All right.
How are you, buddy?
Pretty good, man. How you been? How was your holiday?
Holiday was good. Trying to get back in the swing of things. It's always tough that first day back.
Yeah. Yep.
What'd you do?
Well, me, I took it easy. I mean, obviously the weather being hot as it was, but it is what it is. But, at the end of the day, right, like you said, got to get back into it. Nothing like what we're doing right on a Monday, making it easy for everyone to pay attention to what we're talking about, huh?
I know. It's a epic lunch and learn. We're back here. I got Vince with me. Yeah, no, definitely. Over the weekend, I was out of town. It was very hot and humid in the Midwest, and I was in a hilly area, so I was going up hills and down hills walking. So I guess that was a good workout. But today's a beautiful day, 82 degrees, and not as humid as it has been. Maybe
Yeah.
that rain helped out.
Same thing last night. The minute that rain hit, I was so happy. I was like, oh, the rain's gone. Half hour later, I'll be all dried up, and it cooled off a little bit.
Yeah. And I said, last week we didn't do this, but we did this 2 weeks ago. I wanted this to become like a staple of just expectations that people have. That basically, Epic Mortgage, Epic Spotlight will do a Monday lunch and learn, kind of talk about not just mortgages, but we're unlocking money moves that most people overlook, having conversations that hopefully can set the tone and set the right expectations. So that's what we're looking to do, and I'm glad that you're able to join me today.
Glad
And
to be here. Thanks for the offer.
yeah, no doubt, man, no doubt. I mean, we can just talk about it. Obviously, you've been a loan officer. Why don't you let everybody know just what you're up to?
Well, I've known you for about 15 years of being a loan officer, a long time, and I've been in the business for about 22. It's the only thing I did coming out of college. Stayed in operations to beginning, learned underwriting, closing, moved into sales, and just stayed in originations all the way through it and through two downturns, right? '08, and you can call a little bit of a downturn back in 15 and 16.
You're not even going to talk about COVID. I mean, that initial COVID months, were you scared?
Well, I mean, definitely everyone was scared from the standpoint, right? We couldn't show even houses, right? You weren't allowed to go out. So how are you going to buy a house? But technology showed us that you can buy a house without ever having to walk through the doors today.
So true, so true. It
You
was
know,
one of those weird situations where it felt like, I just didn't know what was going to happen. That March, what was it, March 15th? And really March and April were just so weird. And then all of a sudden, everything doors opened up wide open from May 2020, and moving forward. I was reading a stat talking about the peaks and valleys of just interest rates, and I think
yeah.
the lowest it hit was like probably January of 21. Rates were in the twos.
Mm-hmm.
January of 21, and then as the high benchmark, just showing you how extreme this business can get. The high benchmark, I believe, was in November of. It might have been November of like 2020. I think in November of 23
Mm-hmm.
is when it was just nasty. Just
We actually hit the 8% peak,
8%,
right?
8%.
And when you really think about that, look at the range, right? But you still drag a chart out, and historically, you're still sitting somewhere in the 6 and 7% range from a historical picture. I want to do one spin on that. Think about it. When COVID first hit, the conforming loan limit was 400,000.
Mm.
Today, the conforming loan limit is 800,000.
I love it.
Right? I mean, when we sit here and we talk about ranges and peaks and valleys, we're able to basically buy an $850,000 house with 50 grand down.
Yeah, well, I mean, what does that mean to you? I mean, so what does that say? Like, if we're looking at the macro of that, I mean, does that mean banks just don't want to deal with customers under $1 million? I mean, what does that mean to you?
To me, it just goes to the point of expenses, right? Things have gradually got higher and higher. There's inflation today. We could sit here and talk about all that. But at the end of the day, housing is still the cheapest portion of a person's budget because of what happened because of COVID,
Hmm.
if that makes sense. And to me, it's just, if we took a little bit of an economic stand where people are like, well, values are going to drop, the data doesn't support any point of values dropping. We had, uh, I want to say, seismic shift that there is no way values are ever going to come down to what they were pre-COVID. There's been a change in how we structure housing.
It's definitely interesting because we're on this journey. Like you said, you've been doing this for 22 years. I'm 23 years, and so we're on this journey, and we're just kind of seeing how the story unfolds. And I mean, we came in. I came in right after the .com, right, the .com bubble, and I didn't really understand. Especially coming out of college, I didn't really understand what was going on. I didn't really have a clue. And then, to walk in and then all of a sudden, like everyone's just closing deals, and everyone's making all this money. And then, 2007 happens,
Yeah,
and it's like, wait, what's going on? Companies are going out. Like, how are they going out of business? Companies, are being persecuted, countrywide and all that stuff. And so we're just in this business of just such extreme. It's so extreme one way or the other, and
sure.
so.
And when you look back at those numbers, that extreme is because that was the bottom,
Mhm.
right? When
Yeah,
you really look at housing, that was the bottom, right?
correct.
Statistically, that was the only time values went down in a given year or for a length of 2 or 3 years in a row,
Yeah,
right? And we're talking drastic drops,
yeah,
right?
major.
And there's changes that have come out of what happened there that affect the buyers today
Correct,
or existing homeowners today. As an
correct.
example, people could always borrow money against their home up to 95% of the value in prior to the crash of '08 using an FHA loan. Today you're capped at 80. It's like the government's forcing you to leave equity in your property in the anticipation that something's going to ever go wrong and the banks could never be placed in that position again.
I mean, that's a good thing if you say history repeats itself. So, if we, because one thing I always say is our greatest weakness is our memory. We tend to want to forget things that hurt us,
Sure.
pain that we feel. So we want to quickly subside that. We don't even want to talk about that. Sometimes people, you can almost see them cringe, like, oh, don't bring up COVID again because it was a bad experience. Whether they lost somebody, they lost someone from a mortality, or they lost them just because they are sitting on a different aisle of them now. All of a sudden, because political just got so crazy over the last decade, that we're just in this situation where anything that brings pain, we don't want to talk about it, we don't want to address it. So it is kind of funny or interesting that this is the one pain that we remember, and we're like, okay, we're going to steer clear of this. We don't want this again.
True. But if you look at it too, today's consumer is taking that pain from what happened then and is now sitting on all this equity in their home. And it's like, well, I don't want to do anything because I don't want to give up this low interest rate.
Hmm.
And they're not looking at like what other alternatives can they be doing? How can they structure their debt model? Because the concept is I have this low rate.
Yeah.
But then again, right, the stats show that people are supposed to move every 7 to 8 years. And that's not because of your mortgage. That's because your kids are moving in from grammar school to high school, or you're getting closer to retirement. So people are putting off life choices to stay stagnant because they don't want to give up a low interest rate. But there's ways to still kind of work and tap that equity and do things to structure so you're not afraid of what's coming next.
Yeah, let's talk about that. I mean, that's an excellent point. It feels like milestones, right? That's what you're referring to. There's just
Sure.
milestones in everyone's life. No matter what your last name is, or your ethnic background, or your religion, there's certain milestones in the United States of America that just are. The 21 years old, you can, you're able to drink, legally able to drink, or 16, you can get your driver's license. And even to the point of, to your point of, hey, we're going to get this starter home. We're going to stay here. And that was kind of the mentality, both you and I, same generation, Gen X. What we had was you were supposed to buy a house, stay there for 7 to 8 years, build up equity. You're paying down your mortgage. Your value of the property is going up, not substantial, but just enough that you would have this equity that you would sell the property, primarily a condo slash townhome, and then you would buy a bigger home, which was where you put your kids in there. Put your
Yep.
kids in. Now you're, somewhere around 32 years old.
Don't
You
forget
have
one thing. Our parents drilled in our head. Put 20% down.
put 20% down. There you go. So you got to save up money or get a great paying job. Then you,
Then you got to
like I
give
said,
it to the bank.
give it to the bank.
And then you
So
got to pay them money again if you want it back, right? So we talk about milestones, right? Well, the first one is you get married, you buy a house.
correct.
Right? I mean, the next one is now we have kids.
Correct.
Now one of the rooms are filled. Now I got a responsibility. I got an education fund I got to look to fund, including my retirement account, right?
Correct.
And that's kind of some of the things that when we look at the equity position people have today, when they purchase that starter home in, say, 2019 or 2018, they gained an appreciation that was never seen before in such a short time that they could potentially tap into that $100,000 or sell the current home and go buy a new one and using that money for other things. Because at the end of the day, if you can't access the money of equity in your house, it's not real.
Exactly. Exactly. And the thing is, don't deviate from the plan. And that's what we're starting to see now, right? We see a person making $60,000 a year, and now their mortgage payment is $2,200 a month. And the game plan prior to buying the house was, I need to put $500 away every month into my Roth.
Sure.
But now, now that my mortgage is 2,200, I got to deviate from the plan. I can't put as much money in. And what I'm saying is, no, absolutely not. We have to be comfortable being uncomfortable. We have to get to a point where we have to make more money.
Not only we got to make more money, right? That slice of the pie when we talk about our budget or what comes in every month has to always still go towards some form of a retirement, right?
Correct.
I know you have a financial background, right? To me, I always try and tell my consumers in the mortgages, depending where you're at in your life cycle, the mortgage and the house is your bond portion of your portfolio. I've always looked to take a little more risk, and then you do what you can with your cash. But at the end of the day, if you're sitting at $150,000, $160,000 of equity, and you're sitting on credit card balances and you're not contributing to your 401k or you're not contributing to your college kids' education fund, those are the conversations we need to be having with the consumer to say, yeah, you're skipping out on this, but we really need to talk about a lump sum dropping money into there to do that catch-up period, right? Because those are tax deferments in those growths. And it's figuring a way to use housing and using the equity that you have to help you in that 10-year move up, or 7 years from now when that kid has to go to college. Where are you with that? It's about planning, right? You take the mortgage out for 30 years, but there's a shorter plan. There's kids. I got to get them to 18. I got to get them to 21. I got to get them out of my house, right? It's all about where you want to do and how you want to use what you've had as a game.
So what is your thought pattern? Obviously, Vince, I have a mortgage. I got 4% interest rate. I hear what you're saying, but I don't want to do a first mortgage. Are you convincing them that the first mortgage refinance still works, or are you immediately going to a HELOC?
That's a tough question because there's gaps with HELOCs, and not everyone's going to qualify for a HELOC, right? So a couple things and just parameters. Forget credit scores or anything else. If your credit card balances are higher than your 401k or your kid's education fund, there is no second mortgage. It's a first mortgage. It's pulling as much cash as you can, pay off the mortgage, pay off the debts, and term the loan as long as possible for a 30-year term to bring the payment down until you're structuring your debts. And then credit cards are gone. Now we're on to the education fund. Now we're on to the retirement fund. So everyone's different in that.
There, the situation too with and you hit an excellent point. When the pandemic brought us the pandemic rates, right? When we were all at 2-3%, the decade in time, I believe the average interest rate between 2010 and 2020 was 4.1%, right? So when everyone had these low rates, you didn't necessarily, what's the best way to say it? You got that interest rate, but you didn't earn that interest rate.
Mm-hmm.
Based on your spending habits, you're just in general, you got that interest rate because that's what the market bared, but you didn't earn it. You didn't have a 700, 760 credit score, 800 credit score. You had a 640 credit score, and you still got that low interest rate. So now, fast forward, where you have to earn because you have to have the highest credit scores, of 760 to get the lowest rates, and you don't have it. That is a major issue that's going on right now where people don't qualify for those HELOCs. Those are not bailout loans per se. These are loans that you have to basically qualify for. And that's what the struggle is. I'm seeing a lot of people that were 640s 4 years ago are still 640s now with still the same bad habits. And now they're looking for, some type of bailout situation to consolidate, but they don't want to get rid of the 4% interest rate. They want to keep the 4 and try to get a HELOC, but it's like you don't qualify for the HELOC.
Yeah.
It's a
I want to touch on that, not to interrupt you, but the thing with that is,
Yeah.
right, it's like you said, they didn't earn it in the beginning, but now
Correct.
they have access to all this money that they wouldn't have had. And they're looking at taking a short-term Band-Aid of, let me take a HELOC and pay my car off. Well, no, wait a minute. You probably bought a car that was more expensive than what it was supposed to be, and that's why you need to go take the HELOC. And for me, if you're looking to take a HELOC, you're adding on debt, right? And at the end of the day, you can't borrow more than 90% of the value of your home between the first mortgage and the HELOC. So you're leaving 10% still there. And a couple things, if you look at, well, what happened to the average age of someone buying a house after the COVID? We went from basically 33 to 34 years old to 38 to 39 years old for first-time home buyers.
Crazy.
Right? And so it comes into, if you're in those positions, it's almost like you need to hit the reset button. COVID gave me this great opportunity. I got this low rate. I earned all this equity. How can I structure it? How can I potentially start over and doing what I need to do? And again, I'll fall back to that 7 to 8 years everyone's supposed to be moving from one house to the other. So
Yeah,
to me,
Go
it's selling the house and restarting, right? Because then you're in the position you take the second, 2 years later, you got to redo a kitchen or different things come up. Now, 2-income household, you may be able to afford a higher payment. It all depends as where you're at. But at the end of the day, there's major equity for people to tap into their home, but yet they just don't want to give up that 4% interest rate. But they're paying 27% on a credit card and 11% on a car payment, right? So when we blend everything together, where are we actually at?
Well, yeah. I mean, when we do a blended rate calculator, and we have that, right? Blended rate calculators, we can look at, hey, what is your, it's so funny about interest rates because of the fact that no one knows what their interest rate is on their credit cards, but they all know what their interest rate is on their mortgage. Somehow, some way, our manipulation of the market where we've had such a focus on just one interest rate. They may not even necessarily know what their interest rate on their car is, because car salesmen always go to, hey, your payment's this,
Right.
but they don't know all they know is their mortgage rate is this. And
Yeah.
it's like, what is, and to your point, what is that rate doing for you? What is that rate doing for you? And what is the alternative? So if you don't, take that 7% APR interest rate right now, what is the alternative to your situation? How are you going to get there? And the thing that I always want to be careful with people with the line of credit or the second mortgage, however, I'm always careful in this concept is because you sometimes will get you'll love the interest only payment of it. You'll
Sure.
like you'll like that first 10 years. How are you ever going to pay this thing off?
It's the same thing with credit cards, right? It's a revolving debt. When you get into the $20,000-$30,000 of credit card debt, you got multiple credit cards at the same balances. The only way to get rid of it is to use the equity in the house.
Yeah.
I mean, you don't have a choice. But then again, they're capping you at 80%, which goes to the point of you kind of sell it, you take the advantage, you take the capital gains, and we haven't gotten into that, right? Now you turn around and you just made $150,000 by selling the house. You know what? That's tax-free.
Right.
And a lot of people don't look at that, right? Like that's not a lifetime. That's a rolling every 5 years. You can make $250,000 tax-free from property. Of course, you're not going to make $250,000 every 5 years. But when you look at the charts here today, people are sitting on $200,000 equity in their home.
100%.
And that makes a complete different story, right? Like you take $200,000, you clear it. And again, I'm not conservative on investments, but if you put $100,000 at a 4% interest rate, I know it's not much. That's right, $4,000. Well, you know what? You divide that by 12. That's $400. That brings your mortgage payment down, and the other 100,000 is going to credit cards and other things to bring your overall payment down. Because at the end of the day, it's about here's what comes in every month, and here's what goes out. Because that's the budget you have to work with to make your investments and to make things functionally work, not just about the interest rate on the house. It's everything else in life that comes with it.
No, I agree with you. It's the strategies that are needed now are different from the strategies that were needed maybe 20 years ago, 40 years ago. I mean, with the opportunity that you can have with the money, with the equity that is in these houses, it's just tremendous. It's life changing if you use it. But if you allow this money to get stuck in these walls, if you allow this money to just stay in these walls and not use it, I mean, you're doing yourself a disservice, honestly. I mean, to your point of like, hey, let me just take everything out and let's just see what it can do for me. Come up with a game plan of even if the average home is what, 425,000.
Yeah, average loan amount's about 400,000 right today, right?
Right.
Exactly. Yeah.
So I mean, man, 80%. I mean, we'd have to, I'd have to go on Google right now. What's the average? Let me see if we can find this out live. But like, what's the average equity that people have right now? It's just insanity of what you could do with this type of money.
Well, and that's kind of what I mean. Granted, when I talked about the range of conventional loan from being basically 400,000 during COVID to now to 800,000, it speaks to the amount of equity that's in people's homes.
Right.
I mean, the other thing too, sometimes I talk to consumers and they're like, well, I'm not investing in my 401k because my company doesn't match.
Right.
But at the end of the day, they have equity. There's a tax write-off for investing in your 401k. That saves you money per month.
Right.
So there's all these different things. And again, if they feel like they're locked in the situation, that's kind of why we did this today, is to kind of show that there are options to still obtain different avenues of still investing and reinvesting or using the equity in the house to put you in the next position for the next home or for your kids' education fund or for your retirement fund.
Yeah, they say right here the median sales price of homes in the U.S. is $416,900, and then obviously Illinois base is $283,900, and then what is the average amount of equity?
Isn't ChatGPT great? Right? No more going through the encyclopedia or whatever
No,
it is, huh?
it's amazing. It's game changing. They said the average amount of equity in a U.S. home is currently around $313,000.
Think about that for a minute. I mean, and that equity position happened basically in what, the last 5 years?
100%.
Right? Like the same thing with a stock market investment, right? I mean, we can sit here and you can nitpick whatever happened in April happened, right? But let's just talk about two stocks just off the bat, just to give a comparison. Boeing went down to $135 a share during that time. It's now trading back to like $215. NVIDIA went down to 85. It's now trading at 155. Those are opportunities that you have to have liquidity or money available or move things around in order to do that. And if you don't prepare for stuff like that, you miss those opportunities in the marketplace, right? Now, of course, I'm talking more like trading, but it's the same thing. That money could have been put in an IRA, and you could have purchased those stocks in an IRA, and you could have doubled your IRA in 3 months worth of time with no tax liabilities or nothing to worry about.
Exactly.
And again, it's opportunity, right? There's an opportunity cost of maintaining this 4% sub interest rate that it's stopping you from growth, essentially.
So you're basically sitting roughly just in the U.S. at a house that's probably worth $420,000. You're probably owing roughly about $120,000, and if you're struggling, I mean, it's all we're speaking broadly, and every situation is different, right? So we want to make sure we recognize this.
Of course, absolutely, right?
I have a buddy. He makes works for the state, makes $140,000 a year, and has saved religiously his whole life. Okay, and his house is free and clear. Maybe he doesn't need to necessarily refinance or sell and pick up. He's sustained. He's well on the way to becoming a millionaire. He just needs to follow that one path. But we're talking about the other, the 80-20 rule comes into play. That might be 20% of people. We're talking about the 80% of people of like, hey, you're living paycheck to paycheck and you're sitting here holding on to this 4% interest rate, and it's not helping you. And you're thinking to yourself, well, I want to make a smart move. Why would I go from 4 to 7? That's not smart. And it's like, well, guy, we're talking about having liquidity, an opportunity to live freely, having bills paid off, having a chance to start over again before you end up, bankrupt or with a score you can't do anything with.
Yeah. And the other piece to that is you go buy the next house with that profit, you roll that profit into the next home, you keep a little bit for yourself, right? You need that bigger place, your family's growing or whatever it is. Now you're gaining a 4% appreciation on the home on a $500,000 house versus 4% appreciation on a $300,000 house, right? So the greatest thing about home ownership is it's a forced savings account, because a portion of your payment every month is going towards principal. And the longer you own a home, the lower your balance is on your mortgage. But there's things that you have to do to prepare for where that is, right? Like, you can have all the investments in the world, but if you're turning a 10% profit on a $10,000 investment, you're never really going to build that wealth. But if you take $100,000 and you earn 20% for 3 years in a row, you doubled your money.
Say that again. That's a good one. Say that one more time.
So if you have $100,000 and you have a return of 20% for 3 years in a row, you now have $200,000. If you had $10,000 and you had a 20% return, you doubled your money, but you only doubled 20. You only doubled 10 to 20.
Mm-hmm.
And if you double 200 one more time, what is there to really look at? And again, it's all about planning, right? And I'm not trying to sit here telling everyone, hey, go take money out of your house and go throw it in the stock market. That's not what I'm trying to say.
No.
I'm trying to say that there's so much equity that's been built in such a short time frame that you have to be willing to do something with it in order to continue that growth of your financial future.
I always talk about Epic Mortgage. I always bring that up as an example when people ask me. I said, I'm a living, Epic Mortgage wouldn't be here if we didn't have equity in my house.
Right.
You know what I mean? The whole concept of like going to a bank and asking for, hey, I want to start a mortgage company. That's not existent. This is not a sexy business that everyone wants to be an investor to. So you have to have your own kind of money and liquidity to be able to do something like this. So it's really, there's no strings attached with this money. You can do what you want with it. So if you have a belief in yourself, hey, I believe I can be successful. Hey, I can start my own business. It's right there in your walls. Take that money out.
It goes to that fear of what happened in 08, right? Like that's the kind of the same concept. It's just taken that much longer for people to say, no, I have to make this move. I have to go get the bigger house. My wife, our kids are growing. The loft that I thought was my office is now a storage room, right? Like I need the extra space, right? And that's what it really comes down to. Rates are always going to go up and down. I don't think they're ever going to go to the levels that they were.
Sure.
Right? I mean, realistically, I think we're going to see sub 6%, high fives somewhere in 2026, 6 1/8. And again, that's historically still a low interest rate. The problem the problem is the house values went up so much.
Well, that's the thing. I just got off the phone right now with a future buyer, and she's like, "Hey, my rent went up. My rent went up from $1,300 a month to $2,600 a month."
Whoa.
And she's like, "I guess so. I might as well own something." And I was like, "Yeah." I was like, "Well, where do you want your payment to be?" And she's like, "Well, I don't want a payment over $2,600, because that's what my rent payment was." And it's like, well, let's see what, we're going to have to reverse engineer and see what that 2,600 will bring you, obviously depending on the amenities that you want, the full finished basement, how many bathrooms, how many beds, all that jazz. But, it was interesting to kind of hear that mindset. Like you're worried about a payment per se, but you're not really factoring in the benefit of having a house versus, paying that money.
Well, and then, granted, we don't do this too often, but like, that payment, assuming assessments, probably a house between $250 and $275 in today's market.
Sure.
Right. But then the other thing is you're now getting a tax write-off for taxes for the property. You're getting to write off that interest. So does that bring your actual payment down to like $2,300 a month when you factor in the refund that you get from the IRS with your taxes for owning a house? And no one communicates that. And it's like the same thing you said when you walk in to buy a car. I want this car. I want my payment to be at $650 a month, right? Okay, great. And they'll make the math work, right? Because you gave them a number.
Yeah, I mean, and that's really we're so prone to the number as far as a payment per month because we all have our budget.
Right, the same slice of the pie.
Same slice of the pie, and that was my one of my changes mentally was just saying, why can't my pie be bigger? Or what do I need to do to make my pie bigger? I just want a bigger slice. We get too kind of just formatted into a situation of like, this is my pie. This is all it is. And then I'm trying to fit everything in here instead of expand the pie. And that's a more offensive minded strategy of, hey, I got to make this thing that I live in work for me. Well, instead of me just working for that.
Exactly. It's like you said, your buddy who has the house that's paid off, who's got a job, makes 100. He's just going through the motion, knowing that if he maintains what he has,
correct,
it's going to take care of itself. But if he alters a couple things, it could grow exponentially.
Correct. It's and he's a fascinating study in that because there's no right or wrong, right? I mean, so in theory, I make $140,000. I have small debt, and I can just my house is free and clear, and I'm going to have a pension, when I retire.
Right.
So if and I'm putting money away in my Roth IRA, if I just stay the status quo for the next 20 years, I'll be a millionaire. I'll be, fine. I guess the only thing, from an aggressive standpoint, and this, depends on the person, do you want to get done quicker?
Yeah.
Hey, instead of having that free and clear property, why don't you take $100,000 out and do something with it? Maybe exponentially grow this thing and make it even faster. Could you get this done in 10 years instead of, basically cementing yourself to another 20-year until you retire game plan?
Especially when you have a job that has a pension, right? Hey, I get a guaranteed income coming in when I retire. That doesn't mean I need to touch my IRAs. That doesn't mean I need to touch my investments just because I retired. Unlike us, when we retire, we got to go to our investments, and so do a lot of other people, right? And so when you have to go to your investments at that point in time, you're taking money off the table that can continue to grow. Now your buddy hits his numbers, and then he turns around and gets $100,000 pension a year because his salary is $140, works for the city. He's going to get 70% of his last 5-year average. By the time he retires, it's at least 10 grand, right?
Sure.
And if he's sitting on an IRA that has, I don't know, let's call it 300,000, and he doesn't need to touch it, and the 300,000 is gaining 10%, he's making 30 grand every year. And that's what it is, right? Like, until you get the money to where it needs to be, it doesn't really grow. And when you get it to where you think it's enough, you have to start taking it. And at that point, the money's not coming in. So you can't, another way of looking at this is, and we've been in the business enough where I'm starting to see previous clients' kids come to me to do loans. And at the end of the day, parents are going to need to help their kids, get started in order to buy a house just because of the expense today. But then the parents is like, well, I don't want to give them the gift of equity on the house, or I don't want to transfer them the money. But at the end of the day, as a parent, when something happens to you, the money's going to your children anyways. And everyone sometimes doesn't want to open up the wallet. Well, you're going to get it when I'm gone. No. You should want to give it to your kid now to see them grow and earn their income and watch them develop instead of, well, there's a nest egg when I pass away. So in the meantime, go ahead and live in an apartment.
The living benefit you're talking about.
Yeah.
We, and obviously we're not financial advisors here, but, one thing with my financial background, I was able to kind of, depict that, we all have 4 buckets when we retire. We all do, it doesn't matter who you are. And primarily it's Social Security, and it's inheritance, and it's a pension, and it's personal savings. And those are the 4 buckets. And so if you are, middle age, in your 40s or 50s, you start have to take a peek at those buckets and say, what do I have here? All right, what's my game plan? Is this going to be enough? And that's the situation where, and that's what I see, and that's when I deal with clients, and it's been a beautiful business to just, to learn. I've been just so curious to learn about behaviors and how things go awry and what went wrong. But a lot of it is just not strategy. It's not planning. It's just living for the moment. And then the moment comes and you're not ready because you have nothing. You never planned for it. You have nothing saved, nothing in any of these buckets. For the most part, everyone knows how much of a pension you're going to have because you know what type of job you have. And for most, nowadays it's zero.
Yeah.
It's a so then what the average Social Security is, and so it's like, is that going to be even around? Let alone.
That's the thing, right? Is it going to be around? But what you did know is when you go to retire, how much money's coming in from those 4 buckets, or what's there, right?
Right.
And a lot of times people will retire and then look at addressing the mortgage situation. You got to address that mortgage situation before you retire. And what I'm getting at it there is sometimes when you retire, you also need to retire from home ownership, Because if you're sitting on $200,000-$300,000 worth of equity, that can work towards covering your rent. Then you don't have a maintenance cost, and you don't have to worry about this or that. Now, I get it. You're giving up that freedom, that independence of your own place. But then again, the way apartments are designed today, it's like living in a hotel.
Yeah.
So, I mean, it all boils down to the planning, right? But if you're 62 and you're going to retire and now you need to address the mortgage and you already retired, you don't have enough income to qualify to do the things we talked about.
No,
More
exactly.
than likely, because the average person is making less in retirement than they are when they were working.
It says for retired workers, the average monthly benefit is $19.80 and 86 cents. So $1,980. That's your Social Security bucket.
And that doesn't deduct $190 for Medicaid.
There you go.
Or Medicare.
So you already know, right? But you already know as of right now that's not enough.
Correct. Right.
That's not enough. And to your point, I had a client call me up. She referred me her sister. Her sister retired last year. And so her sister was trying to do a refinance. She wanted to do a cash out refinance, do debt consolidation. And at the end of the day, she didn't qualify. Her debt to income was too high because of all the bills that she accumulated when she was making her knob. And to your point, in those situations where it was like you need to attack the mortgage stuff before you retire, before that income change.
Correct.
It's
got to be part of the plan.
We changed, and earlier in our careers, 2003, 2005, somewhere in, we could have some alternate ideas that could occur. But then once but the
your connection's breaking up. Change. I don't know. You got a lag there. Can you hear me?
And now we have to be proactive. Any type of change, deployment, any type of these changes are when we have to really address these situations.
I'm trying to text you. Your connection slowed down. I don't know if you can hear me. Can you hear me?
You still with me?
I'm still with you. Your connection seemed like it was on a lag.
Slow. All right. Can you hear me now?
I can hear you now.
What did you miss?
So a lot of what you were talking of the last about the planning and the bucket. We got to the bucket, and then we talked about the client who retired and then didn't have enough income to qualify, which is exactly what we were kind of touching on. All of that kind of was getting broken up. It was hard for the audience to hear.
Got it. Yeah. So basically, long story short, she retired and she couldn't qualify for a debt consolidation because, she didn't make enough money. She didn't make enough money to qualify. Her debt to income was too high. And it was a situation where she even recognized like, oh, I should have done this before I retired. And I to the point I was saying that earlier in our careers, we could be reactive. Consumers could be reactive, and we could quote unquote bail them out. We had the capability. Oh, you're 3 times late on your mortgage, not a problem. You're 1 by 60 on your mortgage, not a problem. We could bail out situations of like, oh, I got myself into trouble. Can you kind of clean me up and put me back out there again? But nowadays, the rules have changed and the guidelines have shifted where you really have to be proactive. We have to get to and address these items before they happen.
To kind of touch on the senior who wasn't able to qualify, or not the retiree, sorry, I didn't mean to say senior, retiree who didn't qualify, right? The government gave a solution for us. They created a reverse mortgage knowing that people aren't planning correctly, right? Now, granted, I've written a couple. I don't like the loan for people, but it's the only option for sometimes for those clients. And it's basically equity stripping because you're just delaying what needs to be done, right? And what I mean by what needs to be done is the sale of the home needs to happen. You need to reduce the bills. You need access to the liquidity. You don't need access to a checking account that's assigned to your mortgage at 65 years old that every time you write a check, the balance goes up and you lose your equity.
That's true too. I mean, reverse mortgage. I was almost at one time. I said it's the new financial plan for some.
Sure.
It's a situation where basically, hey, it's a very expensive product. No question, it's very expensive. But it is a situation that if hey, I my milestone, right? I bought the house and then I had kids and they moved out and things didn't work out as planned, maybe in the situation, and I just kind of got stuck here, and I really don't have any other outlets, and this $1,900 a month
It's
is not
killing.
gonna, yeah, it's killing me. I mean, I'll just do a quick another question I wanted to have. What is the average mortgage payment? I'm just
32.
right now $2,300, 2,317.
Well, that probably doesn't include taxes and insurance, though.
Yeah, it just says average monthly mortgage payment in the U.S. is around 2,317. So I
No,
mean, this is so case in point, right? If you are only fixed income at 1,900 a month, you can't even afford your mortgage.
right. The math doesn't work,
The
right?
math does not work.
And
Now,
and,
go ahead.
and one thing, the reverse mortgage could be a great product. The only time it's a great product is when all the other buckets are full. The IRA is full, the 401k is full, the life insurance is full, there's a pension. Because at the right interest rate, a reverse mortgage is great because the property value is still going up. You're taking money and you're getting liquidity and you're allowing the other buckets to continue to grow because that's the point. The longer you don't touch it, the more growth you have. But for the person who doesn't qualify, that's not the answer. We're back to being on a delay.
Yeah. Yeah. They, um, what you said, and last year, they're refinance, and they were getting 70 years. They were
You're breaking up, bud.
$10 years.
I'm texting you.
All right, hold on. It's funny. Can you hear me now?
Yeah, I can hear you now.
So it was funny because 2 weeks ago, we were having a little bit of this outage, and I was thinking it was too hot outside that it was messing up all the cables. So got to figure it out. But what I was saying was a couple had a reverse mortgage 10 years ago prior to me, and so I met them last year, and it was like their 10-year anniversary of having a reverse mortgage, and that sucker went from 70,000 to they owed 140. It doubled.
Yep.
And so, case in point, what they wanted to do was refinance to get out of the reverse mortgage.
Sure.
They wanted to stop it because they were starting to get too high where they were nervous that, their grandson, who was going to be the one that was going to take over the house, they didn't want to get it where it was too high where he couldn't afford it. So they were like, hey, can you help us? What can we do? And I was like, here, you don't need another reverse mortgage. Let's get you out of it. Let's get you a payment that you guys could afford and take it from there. So that's what we did. We actually did a cash out refinance to pay off the reverse mortgage. So, I mean, it is a unique product that can help, but you have to be mindful of it and then reevaluate as people are living longer.
Yeah. I mean, it goes to the whole thing, right? Everything always needs to be reevaluated, right? The buckets need to be overlooked, and they sometimes need a little bit of water, or they need a little bit of sand, or whatever it is that is in the bucket, right? Everything always needs to be adjusted.
Correct. And I mean, case in point, if you already know pension is going to be a zero in that bucket, there's nothing you can do. The type of job you have is not going to produce. You know that Social Security right now is averaging $1,900 a month. You know that the average mortgage is $2,300 a month. You know that's not going to be enough. And then you can kind of gauge on inheritance, right? What's coming your way.
You know what's there, right? I mean,
Correct.
it kind of goes back to what, like I was saying, parents need to give the kids earlier if they expect the kids to have the same kind of performance that they had. Things are more expensive because in the end, the money from the parents is still going to the kids.
Correct.
And I understand as the parent, you want to hold on to your financial security, but at the end of the day, you can give a little bit early because it's still yours to give and it's still yours to take back.
Exactly. Yeah, I just think, after, once we get past inheritance, and for some, the answer is going to be another zero. Like,
correct, right? So now I got two empty buckets.
Exactly. So
right?
then personal savings becomes a huge priority in most of our lives of how are we going to help each other, help ourselves really and save enough money. And, and if you're doing the milestones and you get that house, first of all, a house is an asset, but you got to make it an asset and don't make it a liability. Because it starts off as a liability if you're just paying the mortgage. Make it an asset. Take that money out of those walls. I think that's really the theme of today that we've been talking about.
Yeah, I mean, I know we threw a bunch of different things around, right? But I mean, at the end of the day, biweekly payments are going to come back around at the higher interest rates now, right? Take a 30-year mortgage and knock 6 years off of it. Again, I know it's not done to term. No one does the discipline. But there's all these little tricks or little things of disciplines that if you do them, they make a difference in the end. It takes time.
Yeah, I talked about a video I did on YouTube about recasting, bringing that back up. That used to be a hidden secret, but, it could be a gem, for some that have a conventional loan. Talk to your lender and see about recasting your mortgage, especially if you get any bonus checks or any, lump sums. That's going to be an opportunity that you want to take advantage of.
Now, have you ever done a recast where they allowed you to increase the term back to a 30 from a 15 or only on the lower?
No, I've never seen a 15.
Never seen it where they go 15 to a 30 and put a lump sum down and do a recast? We're back to the connection issue, bud.
Have you seen that?
No, I mean, I was talking to a couple that was getting. No, I haven't. I was talking to a couple that was getting divorced, and I brought up the potential of a recast, and I was trying to see if we can go the other way. They're in a 15. Can I recast them to a 30 and have them drop X amount of money down? Because in their divorce, someone's going to keep the house, but they don't want to lose today's interest rate. And that's a whole nother show. We can talk about divorces and real estate. Not today. We got to get your connection right.
Of your pension balance.
You're broken up here, bud. So we're gonna redo this. What? Kind of do a wrap up.
Yeah, I can.
Hey man, can you hear me, Dante?
How about now? I can hear you now.
I can hear you now. You're clear. I was gonna say we were talking about the divorce, but we don't want to get into all that because that'll be a whole nother show. No, we're cleared out. Dante, if you can hear me, I was going to say let's kind of maybe end this right now. We got a connection issue. And I think our audience is probably done listening to me for the last 50 minutes.
Well, I can't hear you, but one thing I will say is we'll do an hour in, spend time my lunch. All right, we're back. We're going to finish this up. Sorry about that. A little technical difficulty, but we're going to figure it out. Like I said, real estate isn't just shelter, it's a strategy. And, definitely invite any viewer that checks this out that wants to, talk about their unique situation and see how we can help you. Just reach out to me, 708-905-5300. That's my office line, 708-905-5300. Or you can reach me on my cell at 630-776-2016. My email address is Dante, Dante, at epic.mortgage. We will be back next Monday with a new co-host, and we'll see what we get into and what we talk about. Always what I'll do is for people that weren't not able to get this today, I'll make sure I post it on one of my platforms. So just be on the lookout. So that way you get this information and get it to you. And then don't forget to check out Epic Spotlight. That's where normally you can catch this, taping Epic Spotlight on YouTube. That's where we are. So we're trying to, give you tips. We got a podcast, a new podcast appearing on Wednesday. So make sure you check that one out. That should be good. And we'll keep everything moving. Want everyone to have a great week. Thanks so much for listening, and we'll talk to you later. Goodbye.